GM, good morning. Welcome to the Milk Road Show, the daily crypto show refreshing Twitter like, did he say tariffs yet? No? Okay, we'll wait. I'm your host, Jay Hamilton. It's Wednesday, April the 9th, and we are live on Twitter and YouTube. What's up, y'all? Thanks for showing up. I know you have all got questions right now. So do I. These are incredibly uncertain times. So we've brought on one of the best crypto analysts in the world. I'm talking about Benjamin Cowen to break it all down for us. Now, last night, the milkman and I were hanging out up late, having a bevy, and we were thinking, what are we going to talk about with Ben today? And Ben is the chart wizard, the chart master. Nobody spins a story better with charts than him. So we're going to go through my favorite charts of his right now, and we're going to talk about what his theory is on what Trump is actually doing here. What's his ultimate objective and what is it going to lead to? The S&P 500 has dropped 20%. Does that mean we're in a recession? Does it matter? Does a recession usually come after or before an S&P correction? When might we see some relief? What are Ben's probabilities on when we might see the bottom? We're also going to obviously talk about his outlook for Bitcoin, where he sees as the potential probabilities, two probabilities that he's really been looking at recently. And then finally, Ethereum. Ethereum has gone home, as Ben likes to say. What does that mean? And why might Ethereum actually have the comeback of a lifetime that we've all been waiting for? Now, before we jump in, guys, tune in this Saturday to Milk Road Pro because we're dropping our new report on the Fat App thesis. Really great report if you want to understand where we see value accrual going in the future of crypto when you compare infrastructure to apps. Today's episode is brought to you by MoonPay. Trade crypto fee-free, fast, and on your terms. It's also brought to you by Coinshift, powering top crypto treasuries with their yield-bearing stablecoin CSUSDL. Without further ado, Ben, welcome to the Milk Roadshow.
Thanks for having me. It's a pleasure to be here.
Yeah, man, absolute pleasure to have you. Very excited for this conversation. Okay, I got to start with my favorite question right now, which nobody truly knows the answer to, but it is just such a good question to ask, which is, please, Ben, please try to explain to me what is happening right now. What is Trump doing? Is this an engineered crash? And what does, I would like to lead into, what does the 10-year yield curve tell us about what Trump is doing and what his ultimate objective might be here?
Yeah, I think to a large extent, what ultimately needs to happen, right, when we have inflationary cycles is at some point you have to have lower asset prices, right? If you always have higher and higher asset prices, then it's hard to get out of the inflationary cycle. And so I think you could argue that, and I don't really think he's been shy about admitting this. I think they have really wanted to get lower asset prices to ultimately lower the long end of the yield curve. Now, recently, the long end of the yield curve has actually started going back up, which is not really what they want to see, but we'll see what happens there. But I think ultimately, in order to get out of the inflationary cycle that we're in, you have to have lower asset prices. And by having lower asset prices, essentially what it does is it forces the labor market to loosen up. It reduces wage inflation, which overall reduces, inflation and helps it from becoming too entrenched. Now, obviously, I don't know exactly how tariffs are going to affect the inflationary data. Powell even talked to himself about, is there a way for them to separate tariff inflation from non-tariff inflation, right? Because one's a little bit more artificial than the other. But I think what's going on is they know that in order to refinance their debt, in order to get interest rates low enough to revive the real estate market, they need to get a long the yield curve down. And history shows the way to do that is to have lower asset prices. I think that's what he's trying to do. And let's hope it's successful. There's always a chance that he gets more than he bargained for if asset prices stay too low for too long.
Yeah, I think it's a simple formula when you think about it, as if you were to bet that Trump's objective is focused solely on real estate and his real estate holdings, which is maybe a a view that not everybody will like, but let's dive into that view for a second. You know, what would you do if you wanted to lower the 10-year yield curve? You would lower the stock market. Okay, let's talk about that because he's successfully doing that. Then you would, as a result of lowering the stock market, you would see layoffs and you would see growth slow down, and then ideally you would see Jerome Powell backed into a corner where he moves first. It feels like we're playing a game of chicken right now. Who do you think blinks first here? Is Trump going to blink first? Are we going to see Powell, NQT, and lower rates first? What do you think?
I think quantitative tightening will probably end within the next few months, but primarily because that's what they said. If you look at the minutes from the FOMC meeting in January, they say in the minutes that they're looking to end runoff by about mid 2025. Now that report, the minutes were released on February 19th, and that was the top for the stock market, I believe. It might have even been to the day the top. So they made that announcement, or those were the minutes that were released on February 19th. The stock market dropped 20% after that. So I don't even know if they can wait until mid-year. It's possible they end quantitative tightening as soon as May. I don't really know. I would probably guess it's going to either be at the May meeting, the June meeting, or the July meeting. I don't know which one. But I
tell us which one, Ben. Tell us which one.
Well, I think it'll happen because, because they and they might lower interest rates too, but there's just been a lot of, destabilization recently in markets, and that's at least something they can do. And I'm not saying they're going to start QE, right? Like there's a difference between ending quantitative tightening and starting QE. I don't think they're going to start QE. I just think they're going to probably get to the point where the balance sheet is relatively flat for a while. Still might be a couple months away, or at least a month. The next meeting is about a month from now, but that's what I think will happen. I mean, I think Trump will probably back off tariffs with some countries that are already, in negotiations, like potentially Japan. Could be one of the first ones that he rolls back some of those back from. I think the concern for the markets right now probably is more so, what's China doing? And there's been this escalation over there, and so we'll see how far that goes. But yeah, I mean, it really is a game of chicken. I also think that, Trump has been around for a long time, right? He's seen many business cycles take place. And, he's got to know at the end of the day, like you've had an inverted yield curve for like 2 years, right? Ultimately, when you have inflationary cycles, you do have recessions. And, maybe he's just trying to go through the pain that you could argue was going to happen at some point, regardless. And maybe he just wants to get out of the way earlier on in his presidency rather than, sort of dragging it out longer and longer. Because, I mean, everyone who's been in crypto, what you've seen is like Bitcoin dominance, right? Just slowly going higher as everything else just bleeds back to the safest asset in crypto. And I think he's trying, and that same process, by the way, is playing out in other markets as well. I think he's trying to get us into a sort of like a different regime. He's trying to take us out of that and get us into something else. But the only way to get into a different regime is to cause pain in the markets, which is exactly what he's doing.
So let's assume that Trump is intentionally doing this for the variety of reasons that we said. But is this a lot of people are saying this is the only reason we are in this position that we're in, but it's not. There's other factors at play here. Can you bring up the overnight reverse repo chart and talk us through why you think this is a strong factor as to also this current market sell-off?
Yeah, like if you look at this chart, this is overnight reverse repurchase agreements. This has basically just been trending down since January 2023. If you guys remember, the bull market basically started in early 2023, technically at the end of 2022. But this chart going down, it sort of reflects liquidity getting pushed back into the system, right? Putting liquidity back out there. And you could argue that by doing that, it's allowed the markets to sort of stay propped up for so long. It almost, again, it looks like it went from what, 2.5 trillion. And then by the time that Trump took office, it was at not even 200 billion, right? Not even 200 billion. So you essentially saw, 2.3 trillion of this get moved back into the system before he took office. So a lot of times I think you can think of markets like playing chess. If you have one weakness, it's easy for the market to ignore, right? If like the unemployment rate is maybe slowly going up or inflation is slowly going up, the market can ignore it. But if you have tariff uncertainty, you have, you're basically back to a lot lower liquidity conditions. People are exhausted from watching high risk assets bleed out against low risk assets for the last 3 years. You also do have a slowly rising unemployment rate and the uncertainty associated with whether tariffs are going to cause more inflation. And it's kind of like you have the perfect storm for a drop in the stock market. And we already had a 21% drop, right? Which is, I mean, that's a substantial drop, not only because, I mean, it's 20%. I mean, I know for crypto traders, that's a Tuesday, but in the overall markets, right, in the global markets, the S&P dropping 20% is a big deal. And it's even a bigger deal because of how quickly it happened, right? It happened in basically just a month and a half. And that can lead to, margin calls and liquidations and all sorts of stuff, right? So, and that's potentially what's going on with the 10-year yield right now. Maybe someone's just getting liquidated, and that's what's happening over there. I don't know. Remember, a lot of times people are forced to do things not because they want to, but because the market conditions are forcing them to make certain decisions.
Okay, I want to take a look at the S&P. S&P being down 20% is that alarm bell goes off for a lot of people. Okay, got to pay attention to this. Not necessarily a freak out moment, but certainly a sign that says, okay, what's happening here? Are we going to go into a recession? Is there more pain to come? Can you pull up the S&P and can you talk us through where you think we are right now? And if I've heard you talk about how a 20% correction could be the bottom now, and maybe we're already in a recession is what some people are saying, or there's also the possibility that this is the start of an even bigger slide. I know you don't have a crystal ball and you can't predict the exact future, but talk us through some of the scenarios that you see.
Right. Well, I mean, if you've looked at the yield curve for a while and you kind of just have the baseline assumption that inverted yield curves upon uninversion lead to recessions, the baseline drop is a 20% drop, right? I mean, this has been a 20% drop. 10% drops are common, right? You can have 10% drops outside of recessions all the time. In fact, we had a 10% drop back in 2023, right? We had a 10% drop. We even had about a 10% drop right here in 2024. So 10% drops are relatively common, and they can happen certainly outside of recessions. 20% drops still don't have to be recessions, but there are prior recessions that finished after 20% drops. One example is the recession from 1990. One example is the recession from 1980. Those are both about 20 to 21% drops. There was also a recession shortly after Reagan took office in 1981, but from the high before he took office to the low was about a 27% drop. The left translated cycle that occurred in 1968, 1969, it was about a 37% drop, right? So yes, it's true that it is possible to have 50% drops like the financial crisis and the dot-com crash, right? This is the financial crisis right here, and then the dot-com crash in 2000, 2002. It is possible to get and even there was one over here back in 1973 where we saw about a 50% drop. It is possible to get drops like that, but there's also some recency bias, right? Like just because that was the two, I mean, I'm excluding the pandemic because it's not really, a recession it's not the same type of recession, right? I mean, than what we had in other recessions where it was more prolonged drawdowns for the most part. So I think you just have to be like, as an investor, you have to be aware that the reason why the stock market is trying to hold on here at 20% is because there are going to be a certain percentage of investors that are going to come to the table now that the market's down 20%, just because they know there's a chance that that's all you get. There's also a really good chance that regardless of whether it ultimately breaks down lower, it could always get a bounce back up first, right? It can always bounce back up and then come back down later on. And I would, if it does bounce back up and then come back down to this level, then it would be even more likely to break through, right? If you keep knocking, eventually the door will open.
Mm-hmm. Mm-hmm. When we think about what happens next, and you've been, as you always are, hypothesizing about different patterns and looking into the past. And one chart you've been talking a lot about is the S&P divided by the world money supply, M2 money supply. And a really interesting pattern is happening here. Can you walk us through this pattern that you're seeing in the comparison to the past and how you think this could play out here, one potential scenario?
Yeah, so this right here is the S&P 500 divided by M2. And I've been tracking it for a while, and basically we've had, the bull market started right here at the end of 2022, similar spot, June of 96. And then in both cases, the market rallied up for a couple of years. So I mean, I guess you could even take like a bar pattern and pretty clearly see like what I'm talking about there, where if you just kind of overlay it to today,
Mm-hmm.
it's basically the same thing, right? It's basically the same thing. Now, it's not entirely clear, and I know people could look at that and be like, oh, well, that means we're going to get another major rally higher. That's a possibility. It really depends on how long this uncertainty goes on for and how long stocks stay low. Let me explain. The way that the stock market really goes into full-blown 40%, 50% recessions is because you get lower stock prices that stay lower stock prices, right? And if stock prices stay low, then companies are essentially forced to lay people off. And that ends up starting a negative feedback loop where then those layoffs then lead to less demand in the economy, which then lead to lower stock prices because companies aren't earning as much, which then leads to more layoffs, right? And so you can get into that negative feedback loop if you're not careful. I don't think we're in that feedback loop just yet.
Not yet.
Right. Initial claims are still relatively low. But there's always a possibility that if President Trump isn't careful, he could induce one, right? He could induce one. Now, in 1998, when we had that drop, it happened over just a couple of months for the most part. Technically, from the high to the low, it was about 11 weeks, but it happened relatively quickly. And then once the uncertainty back then was over with, we saw another move up because the unemployment rate wasn't skyrocketing just yet, right? So the markets will always they'll defer to go up unless there's a reason not to, right? And usually the reason not to is either a skyrocketing inflation print or skyrocketing unemployment. Also, there's geopolitical risk, but that's kind of impossible to really speculate on. Like, I'm not a geopolitical expert like everyone on Twitter.
Especially right now. Everybody becomes a geopolitical expert right now.
Yeah. So what I'm looking at right now with the S&P divided by M2 is, there was sort of this area back in 1998 where it bounced sort of around these levels, and then it got another move up. It also bounced around these levels in April of 2001, right, which was a post-election year. Now we're in a post-election year right now, April of 2025. So what I think will likely happen at some point in the next few weeks, and you could still hang around these levels for a while. Like if you zoom in here to 1998, what you'll actually notice is that it wicked to the area we just went to, and then it kind of got a counter trend rally for a few weeks, and then put in a lower low, and then got a larger rally. And then also in 2001, right, it went down, got a rally back up, and then it went down again. So my guess is that the market might hang around these levels for, a couple of weeks or so. And then at some point, I would expect a counter trend rally, right? And I mean, we could go to 4,600 potentially before that happens. 4,600 would be that if it emulates 1998 perfectly, because in 1998, we had a 24% drop. So far, it's been about, a 21, 22% drop. By the way, a 24% drop, which I don't know if it's going to get that immediately, but if it does, that actually puts the S&P back at its 200-week moving average, right? And there's actually been a lot of times where the S&P likes to find support around that 200-week moving average. So that would definitely be an area where the bulls would likely try to come and defend. But yeah, I mean, if you look at the S&P divided by M2, my guess is that there will at least be some form of a counter trend rally as we get later into the spring and potentially the early part of the third quarter. I think the hard part that we're going to be asking ourselves whenever that rally occurs is it a counter trend rally to a lower high, or is it a rally to a new high? And a lot of that, I think, simply depends on how long we stay at these levels before we get that rally, and also how low do we actually go? Because I mean, there are examples like 1987 where the market just kept dropping, and it ended up dropping over 35% before it finally got a bounce. And I mean, those conditions, while they would likely be scary, historically, when the market drops that quickly, that fast, it's crazy buying opportunity, right? It's like the pandemic crash. Like when you drop 30% in a month, it's hard not to buy, because everything is down. And the argument is whether it's a counter trend rally to a lower high or not, you're still likely going to see some type of mean reversion at some point. I mean, there's always sort of the outside chance that it's just like a 2008 style crash, but hopefully, let's try to be optimistic and hope that's not what's happening.
I like your optimism. I'll stick with you on that for as long as we can. You said a lot that the next few months really depends upon the next few weeks.
Yeah.
There's a lot that's happening in the next few weeks. We get CPI tomorrow. Today we get the FOMC minutes from the last meeting in March. We get PPI on Friday. Obviously, how quickly Trump makes any changes to tariffs is going to have an impact on how long this pain might last for. What are the scenarios that you're playing out in your head in the short term right now, and the things that you're watching closely?
So inflation's tomorrow, and I think that's going to be a big print because a lot of people are worried about tariffs and everything right now and how that's going to affect inflation. There's a chart from the 1970s that I'd like to talk about briefly, and it's basically where we had these left translated cycles where we had peaks that occurred when a new administration came into office, and then we went into a recession. The macro is actually not the exact same as back then, because back then the thing that led to the left translated cycle was actually rising inflation and lower unemployment back then. So we were getting more wage inflation, and that's why the markets topped out. In the months preceding this, we've actually seen lower inflation and higher unemployment. But the thing that I want to draw your attention to is what happened on the next print. Okay. So back in 1972, we had a cycle where it was a right translated cycle, right? A right translated cycle, or sorry, in 1966, we had a right translated cycle and we had a 1-year bear market. And then we had a 2-year bull market and a 2-year bear market, right? A 2-year bull and a 2-year bear. And then that repeated again, right? We then had another 2-year bull market and then a 2-year bear market. But what I think is important to look at here in one of these inflationary cycles, you'll see that inflation started to go back up in 1972, 1973, but it was the March print where inflation went from 3.8% to 4.8%, right? So it went up a whole percentage point. Now we're about to get that print tomorrow, right? The March data point. So I've been kind of waiting to see what that happens, where that comes in. I think a lot of market participants are curious, will some of this tariff stuff, I mean, I don't know. It might even be too soon, honestly, for it to be reflected in some of the inflation data. But I am curious as to where that comes in. And if you go look at some consensus for inflation tomorrow is actually pretty low, I think, like 2.5%, 2.6%. So, and if you look at Michigan inflation expectations, they're skyrocketing right now. But there's actually, it's kind of interesting because when you look a lot at inflation expectations in the past, whenever they get too out of hand to the upside, normally the public is worried about the wrong thing, right? They're worried about, inflation. And I used to be more convinced about this narrative than I am right on today, and I'll tell you why. But as consumers get tired of spending all this extra money on groceries and DoorDash and dining out, right? People start to lower spending. And so you could argue that because the Fed has gone higher for longer, because they've been in sufficiently restrictive monetary policy conditions for so long, there's a chance that the consumer is actually starting to buckle under the weight. And so you might have, I'm not saying we go out into fully deflationary, but there are some deflationary forces that are going to try to counteract some of those inflationary forces coming from the tariffs. So I'm not as worried about a complete secondary wave of inflation. The only thing that kind of makes me not as convinced as I have been for the last 2 years is these tariffs. I don't really know how the tariffs might affect things. I mean, if you just initially thinking, right, you would think it would increase inflation, and I think it probably would. But also there might become a point where the consumer revolts and says they're no longer paying those higher prices.
And I think as well, it all comes back to what Jerome Powell and the Fed thinks and their view. And as you said before, he has said that he sees tariffs as transitory inflation and wants to think about them differently than consumer inflation. And that might give him the leg he needs to stand on to say, yeah, I'm comfortable, ending QT earlier, perhaps in May, or I want to cut rates, which he could definitely do in May. Seems like the market might even be pricing that in at this point. Okay, I want to shift gears to Bitcoin and ETH and your outlook there. Before we do, we just need to take a quick moment to hear from our sponsors who make this show possible. Let's be honest, everything in crypto comes with fees, but here's a nice surprise. MoonPay Balance doesn't take a cut. You heard that right. No MoonPay fees when you buy or sell crypto with your MoonPay Balance. Top up with dollars, pounds, or euros, then you're ready to trade instantly whenever the market moves. And if you change your mind, withdraw your cash, no MoonPay fee there either. Simple, fast, and ready when you are. Check it out at milkroad.com/MoonPay. Today's episode is also brought to you by Coinshift and their yield-bearing stablecoin CSUSDL. Don't just hold basic stablecoins, earn yield, all without compromising security. Backed by regulated real-world assets and secured with institutional-grade risk management by our friends at Stakehouse Financial, put your treasury to work to earn native yield and protocol rewards. Built by the team behind Coinshift, which is trusted to manage over $1 billion in business treasuries on-chain, including Aave and hundreds of leading institutions. CYCS USDL is gaining traction today at milkroad.com/Coinshift. All right, we're back. Ben, let's dive into Bitcoin. And my first question is, and the question I think that's on everyone's mind right now is, will there be a retest of the 2024 high? Oh, you're muted, Ben. I think you muted yourself.
I think it's almost already happened, right? Because the low so far is 74.4. I mean, it's practically there at this point. In fact, I would guess that if you look at Bitcoin divided by M2, it's already tested it. Yeah, I mean, you could see that it's already, if you look at account for Bitcoin, if you count for the money supply, it's even already gone below the 2024 high. So yeah, I mean, I think if you look at this is essentially a retest of that high. And my argument as it relates to sort of right translated and left translated cycles, and I've kind of stood by this for a while, and this was back up at the highs. My sort of thought process was that, if you de-risk a little bit, you go to say like 1/3 cash or something, it gives you some flexibility if it is a left translated cycle, right? Because what I'm thinking right now is that if it's a right translated cycle where we get a peak in, say, Q4 of this year, like prior peaks, like Q4 2021, Q4 2017, Q4 2013, then you would expect Bitcoin to go no lower than the 2024 high, at least on weekly closes. On a wick, it could go as low as 69K and still
be market structure intact.
I think confidence in the market could still be maintained as low as 69K. And actually, if you look at if you look at the QQQ right now, it already is at the 2021 high, right? I mean, like, it's already there. So it's not impossible for Bitcoin to do something like that. So yeah, my view is this. I'm sort of operating deterministically, which is kind of a dangerous thing to do. But it has worked out for some things. Like, some predictions have really worked out to be deterministic on, like ETH going home and Bitcoin dominance going higher and all Bitcoin pairs bleeding, right? Like, that stuff has worked out. And so I'm just trying to be like, all right, well, if I'm being honest, I would operate deterministically, in these scenarios. And basically, it's if Bitcoin does not find support at the 2024 highs, or a wick down to 69K is okay. If it goes into the low 60s, if it goes all the way back down here, let's say like 62K, 63K, something like that, then I think the odds are much higher that it is a left translated peak, right? Where you basically just don't get another high this cycle if it goes all the way down there. And the reason for that is because I think investor confidence would have been lost at that point if Bitcoin's all the way back down into the 60s. I mean, at that point, the low 60s, that's actually below Saylor's cost basis, right? His average buy. So I think the low 60s would be a bad thing and would very likely lead to a left translated cycle where you have a bounce, but it would just be a lower high. Kind of like when we were talking earlier about the S&P divided by M2, it would be like what you saw in April, right here, where you get a bounce, but it then just leads to a lower high. And the reason why I even compare it to the QQQ was because we had a Bitcoin ETF launch in January of 2024. And when it launched, Bitcoin's top so far was 54 weeks after the ETF launched. And the QQQ ETF, when it launched in 1999, it topped actually exactly 54 weeks later. And then what happened, and this is where how low we go right now is going to dictate whether it's left translated or right translated. With the QQQ back in 2000, it ended up being a left translated cycle because of this drop, right? You see this drop? This was a 48% drop, right? I think investor confidence was gone. There were so many people that got wiped out. It led to a multi-month counter trend rally, but it was too late to avoid the recession, right? It was too late to avoid that. But that drop was a 48% drop, right?
We're not there.
Right, we're not there. And even in that case, the argument, right, is that there was still a counter trend rally to sell into later to de-risk, if you really needed to. And so kind of what I was thinking coming into this year was, if I de-risk a little bit in Q1, and because I don't know. I mean, I was pretty sure we were going to have a correction because even in 2017, Bitcoin retested the 2016 high, right? So in 2017, Bitcoin had this 35% drop, 33, 34% drop, and Bitcoin actually tested the high and actually went a little bit below the high from 2016. And today, Bitcoin right now is down about almost that same amount, right? Like 32%, 33%, 34% gets you to that same level that Bitcoin retraced back in early 2017. So because I don't have a crystal ball, right? Like, I wish I did, but I just thought, all right, well, look, there's a chance that it's a left translated cycle. Let me de-risk a little bit, back in Q1, and then I'll wait and I'm going to see what happens. Like, I'm going to see if it's just a retest of this high, which if it is, then we should have no problem gearing back up, and maybe that S&P divided by M2 chart in 1998 will come in handy to get another move
follow
up.
that.
Right? Yeah, that's the optimistic view. The pessimistic view is that it doesn't find support there and instead goes down here to be like 40-something% down, like the QQQ. Now, the good news is that unless it's an 08 style crash, right? I have to I guess preface that. I don't really think that's what it is, but in case it is, regardless, I think you would have a rally on the other side of that, right? So I think you will likely have a counter trend rally later in the spring, probably going into the third quarter of the year. And whether it's basically how low does Bitcoin go now dictates whether it'll be a lower high or a higher high. And that's kind of where I am. So for instance, if Bitcoin goes into the low 60s, then I probably would operate deterministically and assume that any rally into Q3 is going to unfortunately be a lower high. I don't want it to be that, but it's just I don't know if you could bring confidence back enough to continue the cycle, because look, crypto has been around for a while, and we've had, every midterm year has been a bear market, right? 2014, 2018, 2022. It's hard to believe that this time will be different. So I'm kind of assuming that 2026 is probably not going to be a good year for Bitcoin. And so as long as we stay about the same level as the 2024 high, then there's enough time to repair the market and go higher. If you go into the low 60s, I just don't think there's going to be enough time before. Yeah, I just don't know that there's going to be enough time before the 2026 sort of midterm year bear market becomes more hard to ignore, and by that point, it's entirely possible that all this tariff stuff really starts to all the layoffs that might come from that can start hitting the data by Q3, Q4 if we don't get past this soon, right? So that's why I'm saying, like, if we can get out of this tariff stuff soon and not keep seeing these headlines every single day, then maybe it's possible that we can just find support and go back up. But I'm mainly watching Bitcoin, honestly, right now to give me insight into whether sort of the fate of the next rally.
Yeah, it's tough to know. There's an optimistic view and a pessimistic view, and it's tough to say which one has higher probability right now, as you say. And really, what's driving all of this is the macro side, and so we'll see how quickly the Fed reacts, and if they are going to blink first, or if we're going to see a deal with China. Obviously, that would be a big win, and that would move things faster. But it's very much of a, now is when you need to stay in the game and be watching closely day to day, because now is when, over these next few weeks, is when a lot of things will likely play out that will impact the rest of this cycle. I want to go ahead.
I was just going to say, there's actually a lot of cycles, even in left translated cycles and right translated cycles. A lot of times, when the weakness persists past March, it usually, there's usually some strength after about mid-April. So, I mean, even the QQQ, when it did get that big drop, it bottomed in mid-April before getting a multi-month counter trend rally. So yeah, I think a lot of these like if then statements, we should find out relatively soon, like what the if part of the statement is.
It's somewhat reassuring, Ben. Okay, let's talk about ETH. People are screaming in the chat. We can't not talk about ETH. Can you bring up your ETH chart with the regression band and explain to us, every cycle ETH goes home, as you like to say, and that makes it sound very cozy and nice. And to most people, ETH is dead right now and done. And going home just feels like a maybe not the right term to use in comparison to the sentiment for Ethereum. But can you explain what Ethereum going home means and why that is so significant for you?
Yeah, so for me, there's always a part of the cycle where ETH goes up, but only because Bitcoin goes up. And when you're in that part of the cycle, you don't really want to own ETH because you're underperforming Bitcoin. And so what you do is you just overlay ETH Bitcoin onto the chart, and you can see that every cycle we go through this process where ETH is going up during, tighter monetary policy, and eventually it breaks down, right? Eventually it breaks down, and then eventually it goes home, right? It goes to the regression band, and it can be 50, 60% drops. And we're seeing that this time has actually not been any different. But if you look at the light blue line, there's not really been a great reason to own ETH during those times because it was just bleeding back to Bitcoin, right? It was bleeding back to Bitcoin for most of 2016. It was bleeding back to Bitcoin for all of that in 2017, 2018, and even early 2019. And then also, 2021, 2022, you can see that ETH was just bleeding against the king, right? And so my argument throughout the last few years is that if you want to buy crypto, just buy Bitcoin, right? Don't buy ETH, because while ETH might go up, the only way it goes up is if Bitcoin goes up first. So when I was tracking this trend line, I kept wanting it to go home. And the reason I wanted it to go home was because I knew that whenever this trend line broke, it would force looser monetary policy to start, right? In fact, last cycle, it was shortly after ETH went home. That's when QT ended, right? I mean, like, I'm not suggesting that like the Fed cares about Ethereum, but I
I
do
was going to
think,
say, is this the
right,
reason they ended QT?
no, but it's I think cryptocurrency assets give us insight into how the consumer, maybe some retail people are doing, like how the average consumer is holding up. And so I always said that, like, in order for ETH to bottom against Bitcoin, you first need you need to have an end to quantitative tightening, right? You need to see quantitative tightening in. But the problem is that, and I remember making a lot of videos about this a few months ago. I said, in order for QT to end, there needs to be a reason for QT to end. And the reason is pain in the markets. And I'm basically saying, like, welcome to the pain, right? This is the pain that the markets need to get a change in monetary policy. And so that's why I think there is a good chance that the Fed will end quantitative tightening sometime over the next 3 meetings. I'm leaning towards May or June at this point. If you had asked me earlier, I probably would have said July. But really, I think sometime between the May to July timeframe is when QT is ultimately going to end. And also note that a lot of times weakness in Ethereum can bottom out in the summer. Even in 2022, we actually saw ETH bottom in June, right? It was actually not November, it was the summer. And even last year, we saw ETH kind of bottom out in sort of the later part of the summer. So I'm sort of operating under the assumption right now that that quantitative tightening will end in the next few months, and then there will be a larger risk appetite relative to Bitcoin, right? So there's some things that I think might change. For a long time, MicroStrategy and sort of the purchasing of Bitcoin there has been really bullish for Bitcoin, really bullish for Bitcoin dominance. If it becomes obvious that a recession is coming and people are just trying to figure out, like, where do they put their money? Like, there's a chance. I know this sounds crazy, and I don't even know how much I believe it, but there is a chance that you look at something like Ethereum, and it doesn't necessarily have all the same type of potential worry, because it doesn't have a single large entity that might get liquidated or something. And I don't really think that's the main risk we should be worried about, but it's one risk. I think the bigger catalyst for Ethereum could be a couple things. I feel like it could be simply an end to quantitative tightening, thus making people take on more risk relative to Bitcoin. And then also, I think the long end of the yield curve going down, because of pain in the markets, could make proof of stake networks more attractive, because then you can potentially get higher yield with some of these assets than you can with a T-bill, right? But you have to think, if you're a conservative investor and you wanna invest conservatively in crypto, you're gonna buy Bitcoin, right? In other markets, if you're just trying to figure out, you're just gonna go buy T-bills or CDs if you really want to be super conservative. And the interest rate for a lot of these proof of stake networks, like the rate that you can get, if it's not even higher than a T-bill, right? Like, what's the point? Like, what's the point in taking that risk on? Because, with Ethereum, it's basically at the same price it was at in June of 2022, right? I mean, it was at $1,400, $1,500 in 2022, and it hasn't really gone anywhere. But I could see that as the long end, if the long end continues to come down, I could see that becoming a catalyst for Bitcoin. So I would even go as far to say, and this is going to sound somewhat insane, but I would even go as far to say that there is a chance that you could have a left translated cycle for Bitcoin, where the top is already in, where Ethereum somehow goes to a higher high on a lower high by Bitcoin. Because if you think about every major rally that Ethereum has had, January of 2018, what was it, April of 2021, a lot of those rallies, or May of 2021, right? A lot of those rallies occurred after Bitcoin's high was in, right? Not before. It was after Bitcoin's high was in, and then attention shifted over to the riskier assets, right? So I don't know if it's the right translated cycle or not, but I will say that I know a lot of people feel pretty bad about Ethereum's price action right now. And, you do bring up a good point, like why call it home if it feels so bad? But I also think there's some perspective that is needed, because Ethereum went through this same exact process in 2019. It just took a lot less time. And feel free to cut me off if I'm going on too long, but I could talk about Ethereum all day at this point, given what's happened.
No, I think I would love you to just finish where you're going with this, which is that, the reason you say going home is because of what has happened in the past after it has gone home.
Right. Well, and look at this. I mean, these lows here are just 10x from 2019, right? 80 to 800, 100 to 1,000, 150 to 1,500, right? And then eventually it breaks down, right? Eventually it breaks down, and then it had a first low just below the fair value at, guess what, 135. Look at this, right? 1,300. And then there was just one final drop to around 118. If Ethereum does get one final drop, which I don't even know, like, I'm not even saying that you should wait for that. Like, I think honestly, DCA is probably a better strategy than trying to time the bottom. But I mean, it would almost be a carbon copy of this chart. Again, I could go on forever, but I think what's going to happen after this process plays out is that you're going to get this type of rally by Ethereum right here, where it goes up and it just keeps going up. But this one only rallied back up to about 300, which would, for this cycle, would imply around 3,000. But I think there's a chance that Ethereum could actually rally a lot further than that whenever that rally begins, which it still might be a couple months away, right? It still might be a couple months away. In fact, it's probably like my base case right now is that rally is still like maybe a month away or something. I don't know. But the reason why it could go higher is because back then, I think the reason it collapsed was because the unemployment rate basically went to like 15% overnight. The market could not ignore the recession at that point. This time, I don't really think the unemployment rate is going to go from like 4% to 15% in a month, right? Like it did during the pandemic. And so you could actually get a much larger rally. And I'd like to show one more thing. Again, feel free to tell me to stop. But if I can pull this up here. So there's this butterfly harmonic, and this is...
Oh, yeah, this is a good take.
Yeah. Like, I've never been much for Elliott wave theory, to be completely honest. And like the fact that I even talk about this stuff makes me roll my eyes, because I'm like, all right, I've gotten to that point. But I followed it for like the last 3 years, and it still does seem to make sense, where you have like your different points here, and so far they match. And this C point, like the A to C, the lowest it would go, and this be a valid pattern, is the 0.886. And the 0.886 is basically, right around $1,200, which, $1,100, I think around $1,200, which is basically, that's basically the same level that it bottomed at in 2019, right? Like it bottomed at like 110, 120. And so I just wonder if you get that, that's your C data point, do you then get your D point where it actually leads to a new high, right? Where it leads to a new high. So you basically get the same rally that you got right there, but it leads to a new high because the unemployment rate doesn't go up as quickly, and then the question is, well, what happens up here at D? Do you actually go to a new low or not? And I would argue it like this, like if you're trying to figure out, like, does it go to a new low or not? I think if nothing changes and this pattern were to play out perfectly, like it bottoms, within a couple $100 of the current price, and then it rallies to a new all-time high, if nothing's changing, if quantitative tightening is still going on, and interest rates are still not coming down, then yes, we would probably get a new low in 2026, just like we had those new lows in the 1970s, where every 4 years for 2 cycles, we had a new low in the midterm year. But there's a chance that the Fed can intervene. So I think these charts operate, especially if no outside forces is sort of operating on them. But the reason why I want to bring that up is if we go back to the chart really, really quick, I want to give a couple of counterexamples so you're not just sort of dreading a new low, even if it does go to new all-time high. Like there is an example like in 1980. Like this is a good example that I like to look at, because I do think ultimately Powell will tame inflation. I do have faith that they will stay the course until the job is done. Basically, what happened back then is you had a 20% drop, right? Then you had in a recession, right? It was a recession. And by the way, we might be in a recession now. I mean, look at Atlanta Fed GDP. They're calling for, let me see if they've updated it today, but negative 2.4% for Q1, right? It's possible we're in one,
Yeah.
And if you
recession is just two quarters of negative growth. So
right, it's possible.
We could be there.
Right. Like that's why I keep thinking.
And it's possible we bottomed, which would mean that, it's possible we bottomed.
Right. So what I'm thinking, I'm choosing to be more optimistic, right? I'm choosing that.
Please.
And what I'm thinking is this. What I hope is this. I hope that Ethereum does one of two things. Okay. First, it needs to bottom, right? And the way it bottoms, I think, is ETH Bitcoin needs to bottom. ETH Bitcoin needs to bottom, and the way ETH Bitcoin bottoms is QTNs, right? So I think that needs to happen, and I'm hoping it happens in May or June. That's what I hope. It would be great if it could happen the sooner the better, because the sooner it happens, the more time it gives us, right, for the cycle. Then, whenever that happens, there's a good chance, I hope, to see some type of move like this for Ethereum, right, where it gets a big rally up. You could still have a 2026 bear market, but it maybe just goes to a higher low, right? It maybe just goes to a higher low rather than a lower low. So, like, instead of, like doing something like this, like, let me draw it out for you so I can. So the butterfly effect video basically says it does this, right? Where it doesn't even have to go lower than it already has, to be completely honest, because it's already gone close enough, you could argue. But it would do something like that. And then it goes to a new low in 2026, where it maybe sweeps that low, right? That is sort of like the bearish scenario. But there's also, I think, an equally valid scenario where it just does this and then just kind of like fades into 2026 into the regression band, and then it just kind of slowly builds out of that, right? Where it doesn't actually go to a new low. But the 1981 and 1980 comparison is not even my favorite for Ethereum. I promise I will stop talking about Ethereum soon.
No, you got to give us your 8990. Your 8990 comparison is is something right now.
And I know it's a stretch, right? It's a stretch.
It's a bit hand wavy, but I don't mind it. I don't mind it.
Well, when the market's going down and everyone's desperate, it's easy people want to look at any reason, right? And so the reason I came across this was I was looking at this chart, like I'm sure most people do. Interest rates minus the 2-year yield. And I was basically just looking at it and thinking, all right, we tagged this trend line in 2024. We tagged it in the financial crisis. Let's try to assume, let's be positive, right? Let's be positive and say it's not that. But let's say it's like the time before that. That's 1989 to 1990, right? That's the 1990 recession. Now, this to me, look, I've heard people talk about Wyckoff distribution the last 5 years. For a lot, like I don't need to hear it anymore for like the rest of my lifetime. Like I've heard it so much, right? But I do wonder if this metric right now is going through some type of Wyckoff distribution, and eventually it comes down. The reason why that's important is because in the 1991 recession, it was when that metric topped out on a lower high that marked the bottom for the S&P. That marked the bottom. So that's why I think it makes sense to watch yields right now and to watch interest rates. When this is topped, there's a good chance the market is bottomed. And it's possible it's already happened, right? It's possible it's already happened. But because I was looking at this chart, I was like, oh, well, let me go see what happened in 1989 to 1990. And if you go look and see what happens, you basically have something that looks really similar to Ethereum today, right? You have this triple top and you have lower lows. And it was in that final lower low that was the recession low. And then you finally got a rally to a new all-time high. right? So the way I think about it is this, right? This is the way I think about it for Ethereum, or not even for Ethereum, for a market in general that isn't dead. It'll try to break through. If it can't, it'll go lower. It'll get some new buyers, and then it'll try again to break through. Still not enough buyers, still not enough demand. So it goes a little bit lower, right? It goes a little bit lower, gets more buyers, goes up again, still not enough. And then it finally goes down deep enough in a recession where you finally have enough bulls, right, to then break it through a high, okay? That's what I think you could argue the same thing is happening for Ethereum, where it's, it's not dead. It tried to break through, not enough buyers, right? Try again, still not enough, right? And you try again and you still don't get enough. What if it's finally going down? I didn't mean to draw it that low. Sorry, I don't want to scare people. What if it's finally going down into this sort of like recession low? And then by the time they call a recession, the lows are already in, and then it just gets disrupted. So that is what I'm hoping for Ethereum. That's what I really hope happens. And honestly, I mean, I have thought that, and this is going to sound weird, but I have thought Ethereum was overvalued for like the last 4 years, because this is the chart that I use, right? Like, I think that the fair value is on this chart. Like, that is where the fair value is. That's where I want to buy Ethereum. And it literally hasn't been in this band since 2020. And now it's finally back here. And of course, now that it's back here, everyone's saying Ethereum is dead. And look, maybe it is, but I have not come to that conclusion, right? Like, I have not come to that conclusion. I think it's still alive. I think the reason it has sucked so much for so long is because of tighter monetary policy, fears of a recession,
extended monetary tightening,
right? Higher for longer,
right? Like,
higher for longer. And also, as I said earlier, yields, right? If you can earn, if you can earn 5.5% in a money market or a T-bill or a CD, that doesn't really make a compelling case for proof of stake, right? But if rates drop to like 3%, 2 to 3%, then I think you have a case again for for some of that proof of stake stuff. Then because not only do you want to earn that that maybe like that 4%, 5%, whatever network it is, but now you're also looking at an asset that is potentially undervalued. So now hopefully you're making 4 to 5% on top of appreciation in the asset.
The key thing being the asset actually appreciating, unlike the past 5 years.
Right, exactly. And I think we are getting. I think we're getting to the point, where it could turn around. But I mean, look, it's already gone to 1,300. Like, that's good enough for me. I think it's possible it goes a little bit lower, maybe down to like 1,100, 1,200, but there's no guarantee.
Okay. 2 more questions before we wrap up here, Ben. And thank you so much for all this. It's been fantastic. First, I just want to, short term, what's your thought on Bitcoin dominance? Do we still have a little bit more to go with Bitcoin dominance before we might see this shift?
Yeah, I think so. I think dominance is going to go to 66% is my base case right now. And the reason I think that is because, like, I mean, it's basically just working up these fib levels. Every time it gets to 1, it kind of, it gets rejected for a while and then goes higher. I think it's likely going to 66%. The reason is not because of ETH Bitcoin, but primarily because of alt Bitcoin pairs. I think that alt Bitcoin pairs need to go down, potentially to the range lows. Like, if you look at some other alts that are higher market cap alts, like Solana, like the Sol Bitcoin pair, I think that is dropping. I honestly think Sol Bitcoin is just following ETH Bitcoin. It's just delayed. So I think that as you see some of these other alts give some of their gains back against Bitcoin, you're then likely going to see alt Bitcoin pairs go to the range lows, and that should help Bitcoin dominance get to 66%, which might be the top. And the reason why I say that is if you actually look at Bitcoin dominance plus USDT dominance plus USDC dominance, we just hit a level that when we hit that level last cycle, the Fed ended quantitative tightening 1 month later. Okay. So this is sort of like your measurement of your flight to safety. And so that's why I'm thinking, like, all right, well, if this metric just goes up into May or June, I'm thinking that the Fed will end QT. That's exactly where they ended quantitative tightening last cycle. If you overlay total assets held by the Federal Reserve and just sort of take that up, that's exactly where Bitcoin dominance plus the stablecoin dominance topped out at. So I think you're going to get one more move up by dominance. I think you get one more move up, all Bitcoin pairs to the range lows, QT ends, and then we make a transition into the next phase of the market cycle. Hopefully, we can actually get some, actual risk appetite going for the higher risk cryptocurrencies, and I hope that there's not too much damage done, right? Where we just go into a recession, a full-blown recession. So there's reasons to be optimistic, but there's also some reasons to at least proceed somewhat cautiously.
Yeah, and really, it's a matter of time right now, and how quickly we can move to some sort of a shift and a resolution, which anybody's guess, as you said, does the Fed blink first? And do we see something happen in May? Do we see Trump pause tariffs or make a shift on tariffs? Anybody's guess on which happens first and how quickly we get those. And tough to know at what point is the pain too much. Ben, absolute pleasure. Really appreciate your time today. And even though you apologize sometimes for going deep into the charts, we love to hear it, my man. So we really, really do appreciate it. Thanks for joining us today.
Thanks for having me. Pleasure to be here, guys. And if you're watching from my channel, make sure you subscribe to these guys as well.
I was just gonna plug you, man. Everybody who's watching from Milk Road, make sure you guys follow Ben on YouTube, Ben on X, and check out Into the Cryptoverse, his media arm and his data company that produces fantastic reports and videos constantly that'll help you guys stay up to speed and be a smart and safe investor in the space. Mainly, guys, don't leave now. Don't panic. Don't quit. I know that the pain is real, and I know that the fear is great, and the tariff talk is completely overwhelming in the media. A lot of it is noise. Take a deep breath. We're going to make it through this, regardless of whether it happens quickly or in the long run. Assets will continue to go up at some point. So everybody, hold on for the ride. Ben, thanks again for joining us today. Thanks for listening in, everybody. Have a wicked awesome day. We'll see you back tomorrow.